Hey Bowtie Nation, Joseph Hogue here, and after a recent video revealing the monthly dividend stocks that beat the QYLD ETF, a lot of you pointed out that it was kind of a no-brainer. That popular income fund has lost a lot of money, and investors are now waking up to its faults. All you out there in the nation know one of my favorite monthly income funds has long been the JEPI, the JP Morgan Equity Income ETF, but after posting the QYLD video, you started asking if there were monthly dividend stocks that beat the JEPI as well. So I took up the challenge, started researching, and found 5 monthly dividend stocks that do beat the JEPI, including one with a 14% dividend yield, and one that has doubled its total return. First up, Gladstone Capital Corporation, ticker GLAD, with its 8.8% dividend yield, well above the yield you get with the JEPI. Now, all but one of these monthly dividend payers are going to be those business development corporations, or BDCs. That's pretty typical of these high-yield dividend stocks because these special types of corporations get a special tax break for the passing through all their earnings to investors. They make loans and take small equity positions in medium-sized businesses, so kind of like a cross between a bank and a private equity firm. A great resource to research these BDC stocks is the weekly Raymond James BDC report, and as we've talked about on the channel, the first thing you want to do here when analyzing these BDC monthly dividend stocks is to check what's called the weighted average investment or portfolio yield. That's the return the company is collecting on its portfolio of loans, and for that dividend safety, you want this number to be as high as possible above the dividend yield, so what the company is paying out. For example, we see here Gladstone is collecting an average 13.9% yield on its loans and pays out that 8.8% yield. So not only does that spread mean it should easily be able to sustain and grow the dividend, but that stock price should also rise as well. You also want to check that the company's loans are spread out across industries. Here we see an investor presentation that Gladstone reports loans across 12 industries, which is actually not as diversified as most of these others, so a little on the riskier side for BDCs. Here in the historical data tab on Yahoo Finance, you can see that Gladstone has increased its dividend by 135% over the past 5 years, so we know that spread between the portfolio yield and the dividend yield is helping here. Overall, Gladstone Capital has produced an 8.5% total annualized return over the last 5 years, so the price hasn't done much, and your dividend is going to be most or all of the return on this one. We're just getting started, but you might be asking yourself, why are we even looking for alternatives to that JP Morgan Equity Premium Income ETF, the JEPI? It's been one of my favorite income funds in the past. Why change that now? The JEPI fund invests in defensive, large-cap stocks like insurers, consumer staples, and pharmaceuticals. You can see here it's all those bellwether stocks like AbbVie, Coca-Cola, and United Health. That's going to give it safety when the market tumbles. Then the portfolio managers sell call options on the S&P 500, that broad stock market index, to generate cash flow for the dividends. That strategy puts it in a class similar to other income ETFs, like the NASDAQ 100 Covered Call ETF, the QYLD, with its 11.9% yield, and the S&P 500 Covered Call ETF, the XYLD, with its 9.6% yield. But the difference here is the portfolio manager team, with over 60 years of experience in equities and derivatives, and that ability to sustain the dividend while still protecting the share price. You see here in a chart the price returns on the JEPI versus these other popular covered call funds, including the QYLD, the NUSI, and the XYLD. The JEPI has seen its price higher by 13% over the last 4 years, versus losses of 3% and 14% in the QYLD and the XYLD, even a loss of 15% in the RYLD. That all means the JP Morgan fund has produced a solid 12% annualized return over the last 4 years, and while the dividend has jumped around, rising and falling more than individual stocks, since it is a fund holding stocks, that's something you would expect, it's still able to maintain that strong double-digit yield. So the pros of the JEPI are that strong 7.6% dividend yield. Not the highest among income funds, but still more than 5 times the yield you get on the broader stock market average, along with a good price return, which is very rare in these income ETFs like the QYLD. You also get some downside risk protection with those defensive names in the fund. The stocks it holds like AbbVie, Coca-Cola, and Hershey aren't going to make you rich, but they're going to hold up well in a stock market crash to protect your money. But for all its benefits, there are some drawbacks, and it's here where I think you can look to those individual stocks for an alternative. The JEPI does charge a management fee of 0.35% while you hold those shares. Now that's not much, just $35 a year for every $10,000 invested, but it's something you won't have to pay with these individual stocks. The fund also underperforms a comparable group of defensive stocks during the bull market though. The defensive stocks held don't include the tech stocks of the S&P 500, so You wouldn't expect it to keep up there, but it's also underperformed the low volatility ETF, the SBLV, by a wide margin, which is a fund of those similar defensive stocks. And here we see in the dividend history, while the payout is a solid yield, it's jumped around quite a bit from month to month. Now that makes for tough planning for anyone trying to live off their dividends. Now I'm not about to give up on the JEPI, and don't think you should either. It's got a best-in-class history for cash flow and price return, but I think it's smart here to include some of these other monthly dividend stocks that can help you boost your dividend yield and cover some of those downsides to the income ETF. We're just getting started on our dividend list, but I want to thank our sponsor for today's video, Fabric by Gerber Life. Building that financial future that we talk about here on the channel can be a struggle. Think of how much easier it would have been if your parents had gotten you started. You can do that for your kids with a UGMA Kids Investment account in less than 10 minutes with Fabric. Fabric was designed by parents, for parents, to make it easy to plan and manage your family's financial path. With a kids investment account from Fabric, you can get them started investing now and get them excited about saving. Start with as little as $1 a day and watch as it grows, showing your kids all the possibilities open to them. And more than a regular investing account, the UGMA Kids account opens up tax savings as well. The first $1,250 income in the account each year is completely tax-free, and the next $1,250 is taxed at the child's rate. That means little or no taxes each year, and the money can keep growing with compounding returns. More than an education fund, their investment can be used for so much more than a traditional 529 account, including sports expenses, summer camps, and even their first home. There are no contribution limits, and accounts are insured through the SIPC up to $500,000. You can learn more by going to the link here, or I'll put that in the description below. Start investing in your child today. Go to meetfabric.com/Joseph. That's meetfabric.com/Joseph. Back to our list of monthly stocks though, with Gladstone Investment, ticker GAIN, another of Gladstone's BDC subsidiaries with a 6.8% dividend. Now Gladstone Investment is the lowest yield on our list, but you're more likely to see those price returns on this one versus the others. Shares have produced a 108% total return over the last 5 years. That is an annualized 15.7%, so well above just the dividend yield and easily beating that 8.7% annualized yield on the JEPI. Now, how GAIN produces that higher return is through its business model. Gladstone's target investment of 25% equity position and 75% debt versus most other BDCs that aim for less than 10% equity in the businesses they work with. That higher equity ownership does mean higher risk for Gladstone, but also higher returns on those investments. And we see that in GAIN's history of return on equity, which is well above the industry average. The company reported its ROE in March at 18% versus the average return on equity of around 12% across BDCs. We also see here the total return on the shares has outpaced the BDC group in the 5 and 3 year periods. Because that higher equity investment is more risky than the cash flowing loans most BDCs make, Gladstone then tries to lower its cash flow risk with that lower dividend yield commitment, but then the investors see the upside in the share price. I've highlighted Stellus Capital, ticker SCM, lately for its safer business model among BDCs and its high 11.5% dividend yield. Stellus has nearly all, 97% of its loans in first lien or senior secured debt status, which means it gets paid first even if a company defaults. Almost all the portfolio, 98%, is also floating rate, so all in all, this is one of the safer BDC strategies you're going to find. The 11.9% weighted average portfolio yield isn't quite as high above the dividend yield as I'd like to see it though. That's just 0.5% spread above the dividend yield, which is why the company has only been able to increase the dividend by 17% over the past 5 years, as well as some weakness in the stock price. Still, history shows the company's commitment to that cash return, with over $15 per share paid out in dividends since the 2010 IPO, and a 9.7% annualized total return over the last 5 years, beating the JEPI overall. PennantPark Investment, ticker PNNT, offers the highest dividend on our list at 12.5% and the highest annual total return as well. Now, versus that safer model we saw in SCM, PennantPark Investment is more broadly focused across the capital structure. While 58% of the debt here is first lien secured, it still has a riskier portfolio with 22% equity and 13% subordinated debt. That has helped the company produce a high return, 14.9% annual total return over the last 5 years. That is double our investment over the period. Our next monthly dividend stock pays you a JEPI beating yield of 9.3% and has returned almost 20% last year on top of that, but Don't miss out on our earlier video, the one that started this idea, the 5 monthly dividend stocks that beat QYLD ETF for that cash flow and return. Here, the JP Morgan Equity Premium Income ETF, the JEPQ, that's a twist on the JEPI following the NASDAQ 100 index instead, and pays at 8.8% yield, similar to that QYLD with that focus on the NASDAQ 100 index, but with that expertise of JP Morgan managers we see in the JEPI. This one has produced a 20% annualized return over the fund's 2-year life. Now, that's not quite as much history to go off of as these other BDCs, but I still think this one can be a great alternative to the JEPI, or even in a portfolio with it, with this other income fund. The JEPQ holds those stocks in the NASDAQ 100 index, the tech-heavy group of stocks, and then sells call options against them to create its income. That focus on tech stocks in the JEPQ, rather than the defensive names you get with the JEPI, should help it outperform on returns in a bull market, though it is also likely to fall harder in a recession. Now that's why maybe combining the two could be your best option to get that potentially higher returns in the JEPQ, but then the safety in the JEPI as well. Get started on your kid's future with a kid's investment account and Fabric by Gerber Life with the link in the description below. Or click on the video to the right to see those 5 dividend stocks better than the QYLD. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.